What's up, everybody? Today, the most pressing question, and the reason why you click this video might be to see if I can actually talk about taxes while simultaneously exercising on the exercise bike. All right, I'm going to give it a shot. A little bit of multitasking here to get a couple of things done today. A little bit of cardio in as well while I talk. I'm not in super great shape, so hopefully this doesn't go really poorly. The second reason why you came was, hey, look, you said that there are tax strategies, loopholes, maybe if you want to use that term, that President Trump, Vice President Biden have benefited from that I can benefit from as well. So what are those? Well, let's jump right in. Let's not waste time because, like I said, I might run out of breath pretty quick. But the first one I want to talk about that, again, presumably President Trump has benefited from, because I don't actually know. I haven't seen his tax returns, but I've read the New York Times article, and it alludes to these things. So we'll go there. I have seen Vice President Biden's tax returns. I've got a video where we walk through those actually in pretty good detail. But what are the strategies that they're using that you can benefit from? The first one is going to be the S corporation. So if you are a self-employed individual or you run your own business and you are currently a sole proprietor, find that on a Schedule C, or you're an LLC single member where it's disregarded for tax purposes, filing on Schedule C on your personal tax return, or you're an LLC taxed as a partnership with other business owners as well, you could perhaps benefit from electing S corporation status. Now, we won't go into all the mechanics of this, but this is what saved President Biden, I forget exactly which tax year it was, 2018 or 2017 maybe, where it saved him, just this S-Corp election, saved him $290,000 in taxes. How is that? Okay, well, the number one strategy for an S-Corporation is to pay yourself a reasonable salary from the S-Corporation. That is key. You're going to have to figure out, what that is. I'll have some other videos on that too, but the key is pay yourself a reasonable salary. Well, the reasonable salary could very likely be less than what the actual net income from the business is. So if you're a Schedule C business owner, then the net income from that business is going to go on your personal tax return, and all of it is going to be subject to self-employment tax, which is your Social Security and Medicare taxes. All right. So all of the net income is going to be subject to those. Well, if you elect S corp status, pay yourself a reasonable salary, your salary is going to have Social Security and Medicare. Obviously, it's going to tax your salary. But any net earnings beyond that the S corporation has will flow through to your personal tax return. You'll still pay income tax on that, but you won't necessarily have to pay Social Security Medicare tax. So for Vice President Biden, for instance, his wages as a W-2 employee for his reasonable salary, we're already capping out the Social Security piece, but he didn't pay Medicare taxes, which is 2.9%, on about $10 million of income. So that came out to $290,000 of tax savings. Again, this is something. Your business is making net income of $50,000 to $100,000 a year. You've got a plumbing business or consulting business or whatever, real estate company perhaps, where you're a realtor. Making an S corp election for that business could potentially save you $5,000, $10,000, $15,000 in taxes sometimes. So again, this is a case-by-case basis that you've got to look at. All right, the next one, capital gains tax. Okay, this one. Actually, VP Biden didn't have any of this on his tax return, which I'm pretty shocked by. But this was the one, actually, a couple years ago where Mitt Romney was paying so little in income tax. Well, it's mostly because of the capital gains tax rates. And you can benefit from this as well. So again, long-term capital gains have preferred tax rates. Okay, so if you buy a stock, say in Coca-Cola, and you hold it for 1 year and 1 day and then sell it, any gain is taxed as a long-term capital gain. It's not taxed as ordinary income. So if you are in the 10 or 12% tax bracket, which for a married couple right now goes up to about $80,000 of taxable income, that's after your standard or itemized deductions, by the way, not your gross income. So if you're making $80,000 of taxable income or less, and you hold that stock, it doesn't matter what you make on that stock. You can make $3,000, $4,000, $5,000 on it. Now, again, that's going to be added into that income of $80,000, so you can't make unlimited amounts. But if your taxable income is $50,000, you make another $10,000. You bought the stock for $1,000, it went up to $11,000, you waited a year and 1 day and sold it, that $10,000 will be taxed at 0%. Long-term capital gains for you in the 10 or 12% tax bracket will be taxed, again, at 0% income tax. So your ordinary income will be taxed maybe at 12%. Your long-term capital gains will be taxed at 0%. This is how, again, Mitt Romney paid such low income taxes, because he's in the 37% tax bracket when you look at his ordinary income. But long-term capital gains for someone in the 37% tax bracket will be taxed at 20%. Now, there's some other things like net investment income tax that can come into play, but for long-term capital gains, we're basically talking about that 20% tax rate. If you're not quite in that high of a bracket, it could be where you're in the 22% tax bracket, your long-term capital gains are going to be taxed only at 15%. So that's 7% savings right there. So on $10,000 of long-term capital gains, because they're long-term capital gains instead of ordinary income, you just save $700 in taxes. So very beneficial to have some investment income. Okay. Now, another one that is very common, again, I didn't see this on Biden's, actually it was on his 2016 return, but he showed net income, is real estate rentals. And so a lot of times what can happen here is you're looking at your real estate, you say, okay, I can buy this house for $180,000, I can borrow maybe a little bit on it, I can rent it for $1,500 a month, and my rent minus all my expenses, including the mortgage, I'm going to cash flow about $200 a month, maybe $300, $400, $500 a month of income that I can help put into my budget. So I might be cash flowing $500 a month. Well, the purchase price of that house, $180,000, you break the land out because land's not a depreciable expense. But right now, so let's just look at it. You depreciate that house over 27 and a half years as residential rental property. Depreciation is not a cash expense out of your pocket. So it doesn't affect your cash flow from the rental property, but it is a tax deduction. It's an expense for tax purposes, even though it's not money out of your pocket. So that depreciation a lot of times can actually offset any of your taxable income from the real estate. So you can have positive cash flow of $500 a month while showing no taxable income, or even potentially a tax loss on your tax return. So you got cash flow coming in, but you're not paying taxes on it because of this depreciation expense. And that happens a lot in businesses where the depreciation expense is kind of this non-cash expense that helps reduce or even eliminate your taxable income for businesses. This is probably a big piece of what's in a lot of Donald Trump's businesses as well, showing those losses. But that's a benefit you can get. It's one reason why real estate is such a great investment, because you can shield some income from income taxes while generating cash flow and having the renter pay off your mortgage, so you're building equity in this investment as well. And then when you sell it, hey, that's a long-term capital asset as well. So there will be some depreciation recapture where you might have to report some ordinary income on part of that because of the recapture depreciation. But the asset itself, anything above that would be long-term capital gains, as long as you held it for more than a year. And you get that preferential tax treatment, maybe 0%, maybe 15% instead of 22%, where you're saving about 7%. Or 20% if you're in the higher income brackets, but it's still better than your ordinary income tax rate. So those are 3 strategies that the wealthy benefit from these tax loopholes. But I'm here to tell you, these are absolutely available to you. I have people every day making 80, 90, 100,000, some less, some more. They're benefiting from these tax loopholes. I call them strategies because it's not really a loophole. It's available to everybody. Like I said, it's available to you, me, the rich, the poor. You just have to qualify for these by investing or taking steps like the SCorp of making that election and having your own business. So these are available to you. If you have any questions about that, reach out. My name's Brad. I'm a Fluent CPA. My goal is to bring peace to your tax and financial responsibilities. Please hit that subscribe button. I don't know if I'm ever going to do a video again on the exercise bike. As you can see, I haven't been working very hard, just slowly going this whole time, and I'm a little winded because, like I said, I need to get back in shape. So I'm going to cut the video off, finish out the workout, maybe a little bit harder so I can get in better shape. But thanks for watching the video. Don't forget to subscribe so you get notified of other videos as they come out. Thanks.